thing we're often talking about here at Sensible Investing is the importance of controlling your emotions. But of course, that's easier said than done, and no one understands that better than William Bernstein. He's best known now as a financial theorist, but his background is in chemistry and neurology. Bernstein's theory is that human beings just aren't cut out to be good investors.
Basically evolved on the plains of East Africa, where the ability to respond very quickly to a pattern in decisive fashion, if you saw yellow and black stripes off in the peripheral field of your vision, you had to respond very quickly. And those sorts of instantaneous, instinctive, emotional responses are basically death itself in the world of finance. So we didn't evolve well to be in the environment where we're in, where you have a planning horizon of 50 years and not 50 milliseconds. In the modern world, the real risks are long-term risks. The real risk to you is that you don't save enough money for retirement, for your kids' education. Our emotions are basically very dysfunctional when it comes to evaluating those long-term risks. Let me give you a classic example. If the market falls 5% in a day, that's going to upset most people. Heck, it upsets me. But if you think about it, what the market does over a one-day period is completely and totally irrelevant. What matters is what does the market do over 20 or 30 years. We tend to construct patterns, we tend to perceive things where sometimes they don't exist. Now, if you're trying to avoid tigers, that's good. Or if you're trying to tell your friends from your foes, that's generally good. But if you are dealing with complex, nearly random data, which is what you're dealing with in the financial markets. And one of the things that most people don't understand is that almost all financial changes in prices are random. There's almost no signal in there. It's almost all noise. You start doing really stupid things. We tend to want to be in tune with the people around us because human beings are such social creatures. And again, the reason for that is evolutionary. And so when everyone else is buying, we tend to want to buy. When everyone else is selling, we want to tend to sell. And that means two things. It means that markets can be very unstable. And then you also wind up doing the wrong thing at the wrong time.
William Bernstein. That's it for now. Join us again next time. And if you're not doing already, why not follow us on LinkedIn, Facebook, and on Twitter.